Hello and welcome to the 7th of our CIMA F3 Financial Strategy lecture recaps. So, this lecture was on CAPM, but what is CAPM? Well, it calculates the cost of equity. Remember previously we used the dividend valuation method to calculate the cost of our equity, to calculate ultimately the working average cost of capital. Well, this one looks at investor risk rather than the dividends received. Okay, so this is the risk of the investment. So there are different types of risk. The first of these being systematic risk. Systematic risk is market risk. It's the risk that the economy goes up and down, and therefore the value of your investment goes up and down just due to market factors. Unsystematic risk is company specific risk. It's the risk that the company does something wrong or something happens specifically to the company and the value of your share and thus your investment goes up or down. So portfolio theory states that you can diversify your portfolio and eliminate unsystematic risk. What this means is that by diversifying your portfolio and holding a wide range of different investments, the only risk that you have to concern yourself with is systematic risk, i.e. the risk of the market itself going up and down. The unsystematic risk, the company specific risk, has been diversified away because you've got so many different companies in your portfolio that one specific company's risk doesn't really matter. Okay, so that's portfolio theory. So we've got to assume in all the rest of our calculations that investors diversify their portfolios. So the only risk that we're concerned with is systematic risk. We're not concerned with company specific or unsystematic risk. So CAPM then. CAPM is devised by this formula. It's that the cost of the equity equals RF plus beta times RM minus RF. Don't worry if that looks complicated, it's not. RF is the risk-free rate which you'll be given in the question. It's like government bonds, something like that, risk-free investment, say 3% risk-free rate. Okay, RM less RF is the average market risk premium. Okay, RM is the risk of the market and RF is our risk-free rate of return. So the difference between the rate of return on the market and the risk-free rate of return is the average market risk premium. Okay, so RM, risk on the market, RF, risk-free return. Difference between the two is our average market risk premium. Beta then, this beta in the middle, well, that is how much risk premium is required, i.e. the systematic risk of the investment. Okay, so what we're doing is we're saying, right, our company, if the total system or market goes up by 1, how much will our particular company go up or down? So therefore beta could be, say, 1.4, and what's that saying is that if the market goes up by 1, well then our share will go up by 1.4. It's the relationship of our share to the market as a whole. So it's the systematic risk of that particular investment. So the systematic risk, remember, is the risk on the market. So the market goes up by 1, how much does our share go up by? And beta tells us that. So it's how much the share price fluctuates with the average market. So there's a couple of assumptions with our CAPM model. It assumes that all investors are diversified, and as I've said, that means that we don't have to concern ourselves with unsystematic risk. It assumes perfect capital markets, which isn't the case unfortunately. No transaction costs it assumes, but there are. And it assumes that you can borrow at the risk-free rate, which may not necessarily be the case. So, our pros and cons on CAPM then. First of all, the advantages. Well, it's market based. It looks at the systematic risk, and it can be used for specific projects. You can work out the risk on that certain specific project, which we'll look at later. On the downside, are investors diversified? Well, these days a lot of them probably are. Ways in which the return is given are not important, i.e. capital growth or income, and we know from previous lectures that that's not the case. It focuses on one period only, i.e. not the total investment over the life of the project, just one period. And it may be hard to get the data required to actually work out CAPM. So that brings us on to a little bit of a discussion around capital structure. And this is related to how the working average cost of capital will fluctuate. The traditional view stated that with increases in gearing, i.e. the higher you geared your firm, the WACC increased. So at low levels of gearing, the WACC was reduced. At high levels of gearing, the WACC increased. At the optimum level, you could minimize your working average cost of capital. Okay, so somewhere in between low gearing and high gearing, the working average cost of capital reached an optimum level. So basically what we're saying that as financial risk increases, there's a greater return required by the shareholders, and therefore the WACC increases. Your total average cost of capital will increase because the return required by shareholders will rise by so much. Miller and Modigliani then stated that assuming there's no tax, the working average cost of capital will remain constant. The gearing level has no effect on the working average cost of capital because as debt replaces equity, the working average cost of capital stays the same. So your equity costs more, but your debt costs less. So as you replace your equity with debt, they both offset each other and the working average cost of capital remains constant. With tax included, as the debt increases, your working average cost of capital falls. This is because the tax benefits of your debt lower your working average cost of capital. So as you increase the amount of debt, the more tax benefit you'll get and the lower your working average cost of capital will be. So the value of the firm is increased by the tax benefit. And we did a little example of that in class. One last theory is pecking order theory. And this basically says you use the funds that are easiest to get at first. So therefore you use internally generated funds, i.e. profits first. Then you go to debt because it's easier to issue. And then you go to equity because it's the hardest to actually get and issue. So that was our lecture on CAPM with a little bit of capital structure thrown in.